Hi guys and welcome to Price Action Trading School. Today we have our session. It's about margin and leverage. As always, we go first with the theory. Then soon enough we will also get with the practice and we will start doing the various trading methods and systems that will be also part of Price Action Trading School. So today it's margin and leverage explained. I will be talking about both margin and leverage. I will give you quick information about what is the margin, what is the leverage, and which kind of leverage you should be using if you want to trade professionally, if you want to treat this as a business. So as I said, first we will start with basic things, and then we go step by step explaining most important parts of price action. So this is Price Action Training School revised, and it has, as always, four important pillars. It's price action trading, market analysis, risk management, and trading psychology. All of these important points are very, very connected and interconnected between each other. And both of price action trading and trading psychology should be applied if you want to trade professionally, keeping both risk management and, of course, pre-market analysis in mind. So with the first thing first, we will go, of course, explaining what the leverage is. So this is the most important part of the leverage. Before you start doing any trades, you need to be well aware of three important things. The first and the primary thing is not to lose the capital and stay on the flow for many years. Second is gradually multiply your equity figures. And the third task is to earn profits. Do not never set a third task for the first task, because success will come down to a proper risk management. You need to be really well aware of it. So primary thing is managing your capital in a correct manner, guys. That is very, very important. Okay, now important thing also is that you cannot trade with less than 100,000 euros or dollars if you don't have any leverage. Uh, so the primary thing is that you understand the most important point. Just give me a few seconds, guys. I just see the comment. Hi there, Nenad. Sorry, I missed the last session. Don't worry, guys. Every webinar that I do is recorded and it will be uploaded later on the YouTube channel. It's Elliott CurrenSea YouTube. You can subscribe and you will always, you can always see your missed webinars, or you can watch webinars as many times as you like. So brokers will provide you with money that is more than a balance in your books, in your account. So if you trade then less than 100,000 euros, you need to use the leverage. Okay, now the leverage works, as I explained, by establishing a rate you can use for every euro or dollar in your account. So it means that if you use, for example, 50 to 1 leverage, it means that for every $1 you have in your account, you can place a trade worth $50. For example, if you made a deposit of $500, you would be able to trade amounts up to 25,000 on the market using 50 to 1 leverage. So you don't need to, but you can trade up to that amount. For example, 100 to 1 leverage means that for every $1 you have in your account, you can place a trade worth $100. That is a typical amount of leverage that was used before the ESMA announcement. Now, if you are a professional, elective professional, you can also use 1 to 100 or 1 to 500, 400, depending on broker. Now, retail traders start as low as 30 to 1 due to new ESMA regulations. Now, the money that you put for a trade is actually the money you risk. It's margin. So I will be also explain margin a little bit later. So we use the leverage to actually increase the profit potential. Okay, so that is very, very important. Now, for 1 to 100 leverage, we need $1,000, for example, and we then have we will have a contract of $100,000. Okay, so usually when people ask me, Nenad, how much money should I place for my account? I said, don't go lower than 500. Let it be something 500 or 1,000, and then you start to slowly and but steady build your account. So if you make 100 pips, guys, on with a standard lot, you would have made like $1,000. So that is because, as I already explained, for every dollar in content in contract, you actually made 1 cent. And when you multiply, you get the amount of money. So 100,000 times 1 cent. If you make a loss and the value of a contract drops to 99,000, the deal is off. And that means that you are margin called. So that is because we traders guaranteed with the margin. And our margin is actually $1,000 in this example, guys. So let me remind you again. If you have less than 100,000, you use the leverage, right? As I say, you can also use lower leverage if you want to trade with 100 to 1 leverage. I'm just giving you the example of standard leverage. Even if you're an elective professional, standard leverage is something like 1 to 100. So you need to have at least 100,000. Now, it's important to understand that your margin is actually what you made the deposit. So if you made a deposit of 100,000 of 1,000 and you control 100,000, this 1,000 is your margin and 99,000 is the borrowed money from the broker. Okay. And if you lose 1,000, then you will be margin call because brokers don't want to lose their amount of money that they provided you with. So the leverage exists in the way of creating and giving you the possibility of making bigger profits. The, the it's in forex trading, leverage is necessary because you're trading basically the CFDs, and when you're trading CFDs, you need to know that those are leverage products. And in forex market, in trading, it's because of these small price differences, you need to use the leverage. And without the leverage, it would need really a long time to make any meaningful profit. So using the leverage, guys, you will get a return on your investment faster. Leverage should be used wisely. And the thing is that leverage ratio, this is important, guys. Remember, leverage ratio is based on the notional value of the contract that is usually a domestic currency. So this is also important for you to understand. Okay. Now, what is the over leverage, guys? It's something that you should definitely avoid. Your margin is your investment. I will get a little bit later, just a little bit deeper explain the margin. But your margin is your investment. So if you made €1,000 or dollars deposit, it is your investment. It is your margin. So you need to detach your emotions from yourself. Forget about it. You have the margin. Now let's try to build the account up. If you go with a high risk, it's usually called all or nothing. It's a very costly mistake. Mistakes will happen, but just ensure that they don't eliminate your capital. It's important, guys. So mistakes will happen. It's normal, but just don't let it eliminate your capital. High leverage usually works against the speculator. Okay. It usually will work against you because when you see the amount of money that you start making with a big leverage, you might be thinking that you can do this every single time you open a trade. But usually that is not the case. And usually what happens is in a matter of next few hours or next few days, your initial investment is lost. Okay. And you need to then check your heart rate to see what happened basically, because I know a lot of traders who actually had they actually had a lot of stress during trading, and mostly the stress is due to big leverage. So you need to remember this is your investment, you're controlling your money, and high risk, very high risk, all or nothing, we can give you temporary results, but in the long run it won't do you any good. So always remember, guys, you want to trade safe, to be on the safer side of the market, and because of that you need to trade professionally. Remember, small losses are not dangerous. Everyone can have small losses, but if losses increase, then especially beginner traders usually tend to agonize over bad decisions. And you need to focus on the lessons from your mistakes, guys. When I started to trade, no one actually taught me these things. And I was always focused on my mistakes so I don't repeat it and I don't agonize. Spiral of doom, fear, and greed will definitely ruin, guys, your trading career and livelihood. Bankrupt firms, such as, for example, Bear Stearns, Lehman Brothers, they use the leverage of 35 to 1 the most. And now, if they get into a spiral of doom, and you know what happened during the global financial crisis, GFC, there is no one that can save you. So, if you cannot create good returns with low leverage, you can expect massive gains, but more, there will be massive losses because the over leverage. So try to understand and try to learn how to actually use lower leverage in order to create some bigger gains. Remember, guys, stocks can double or triple in price or fall to zero, but currency never does. And lower margin requirement is definitely less risky than it would be for stocks. Now, the margin that you deposit, it's your investment and it's a performance bond. Treat it as a performance bond, not a borrowed money. So that is the amount of equity that is needed to ensure the loss covering. Okay, and there is no interest charged for using the leverage. So just use it wisely, freely, but do not over leverage. Total equity equals to cash plus open position profit minus open position losses. That is a total equity. And it is also displayed on your MT4 platform. Now, what is the margin, guys? Margin is the amount of money needed as a good faith deposit to open a position with your broker. As I already explained, to control $1,100 position, your brokers needs to set aside, if you use 100 to 1 leverage of, let's say, $1,000 from your account. So your leverage that is expressed in the ratio is 100 to 1. So you're actually controlling 100,000 with just $1,000 deposit. So that $1,000 is actually called a margin, guys. Margin is usually expressed as a percentage or the full amount of the position. And brokers will usually require 2%, 1%, or eventually 5%. That is what brokers usually require. So again, margin is a percentage of full amount of the position, and that is your initial deposit, a performance bond. And if you control 1,100 and you put a deposit of 1,000, that 1,000 is your margin. Different brokers, different margin requirements. Now, guys, margin equals to 1 divided by leverage. So 50 to 1 leverage yields a margin percentage of 1 divided by 50. It's 0.02. It means 2% of margin. Leverage equals 1 divided by margin equals to 100 divided by margin percentage. This, as I'm already saying, this is being recorded. It will be uploaded, so you will be able to watch this as many times as you like. And maybe if you watch it a few times, then you will. I just use these formulas that are in red letter, and you will understand it completely. Because I know that there are a lot of even experienced traders that cannot tell you the difference, explain you the difference between leverage and margin. So if the margin is 0.02, okay, it's 2%, and leverage is 50 because you divide 1 with 0.02, that equals 100 divided by 2, it's 50. And pip value. So what is a pip value? It equals to 0.1% of the quote currency. So for example, if you trade euro dollar, the euro dollar, euro GBP, dollar yen, they all have different pip value. And you also have the indicator. I think there are some indicators that can be downloaded that can show you what is a pip value. Pip value is different for forex pairs. So if you trade dollar yen, 1 pip will be worth let's say less than 1 pip of euro GBP. So you need to know that pip value is a little bit different. And the rule of thumb is, guys, do not cross 5% of risk. If you cross 5% of risk, you're in danger zone. It also means, guys, that if you want to make 100% of your account, like 100% of profit, you need to be ready to risk 100%. That is the way it goes. So if you want to make 20%, you need to be ready to risk that 20%. But the rule of thumb is do not cross 5% risk threshold per day, let alone per trade. Because then if you go with over 5% of risk, you will be subject to psychological errors, you will be subject to fear, and you will be in the danger zone. So if you have any questions, guys, just ask me. This is everything that I had for you today. So as I already said, we go step by step. Okay, today it's margin. Next time we will cover more subject, and very soon we will start doing practical things that will make you money if you listen to me, if you listen to what I'm doing. So now at this point, guys, especially for new traders, this is extremely important. So please, if you have any questions, do not hesitate to ask. If you have any other comments, leave it under the YouTube, because this will be uploaded to YouTube under the YouTube video, and I will gladly explain. I can always, if you join our ECS live service, I can always send you a risk calculator, so you can always see what your risk threshold is, and the calculator will give you the exact number of lots that you define per your risk, per your position. So if you need that, just sign up for ECS live service on our website, and I will gladly send it for free. I don't see any questions now, so I guess that everything is clear. So before you start to trade, you need to understand these are basic principles, guys. I'm trying to be as much concise and clear as I can be. So all these basic principles should get into your head before you actually start trading. And very soon we will start with practical methods. Thank you once more for listening, guys. I will be here with you next week. Sign up. That should be on Wednesday. If anything changes, I will let you know. But at this point, I don't plan anything to change. Next webinar is on Wednesday, and talk to you soon, guys. Cheers, Robin. Thank you. Cheers, everyone. See you soon. Bye for now.